Want to start investing, but don't know what to put in your portfolio? I'll show you a simple framework beginners can understand. Building a portfolio isn't about finding one perfect stock. It's about creating a mix that matches your goals and risk tolerance. Step 1. Know why you're investing. Are you investing for a long-term goal, a future purchase, or simply to build wealth over time? Your goal determines how much risk and volatility may make sense for you. Step 2. Understand your time horizon. Money you may need soon generally shouldn't be treated the same way as money you're investing for decades. Step 3. Step 3. Create an emergency fund before taking significant investment risk. Once your basic financial foundation is in place, you can think about your investment mix. One important concept is diversification.
Instead of relying on one company, diversification spreads your exposure across different investments.
For many beginners, a broad market ETF can be one way to get diversified exposure through a single fund. Another approach is owning individual stocks.
Individual stocks give you more control, but they also require more research and can create more company-specific risk. Diversification can help reduce that risk.
So a beginner portfolio could use broad diversification as its foundation, depending on the investor's goals. Now let's talk about risk. Understand risk. Stocks can rise and fall significantly, even when the underlying companies are strong. The key question is whether you can stay invested when markets become uncomfortable.
That's why your portfolio should match your ability and willingness to take risk.
Next, decide how much you want to invest regularly. Consistency can matter more than trying to predict the perfect entry point. Now let's build a simple hypothetical example. Imagine a beginner chooses a diversified core investment and then adds a smaller allocation to individual companies they have researched. The exact percentages aren't universal. Your own situation should determine the allocation. No one-size-fits-all. Also remember that diversification doesn't mean every investment will go up at the same time. It simply means you're not depending entirely on one investment. Next, pay attention to fees. Small costs can affect long-term returns, especially when you're investing for many years. Another important step is understanding what you actually own. Don't buy something simply because it's popular on social media.
Research the business, understand the investment, and know why it belongs in your portfolio.
Then review your portfolio occasionally. If one part grows much faster than the rest, your portfolio may become more concentrated than you intended. That's where rebalancing can come into the picture. But rebalancing can have tax consequences, so understand the rules that apply to you.
Finally, avoid constantly changing your strategy because of short-term market headlines.
A beginner portfolio doesn't need to be complicated. Start with clear goals, understand your risk, diversify appropriately, keep costs in mind, and invest consistently. Your portfolio should be built around your situation, not around what someone online says is the next big investment. Remember, this is an educational framework, not personalized financial advice. Investing involves risk, and you can lose money. If this helped you understand how to build a beginner portfolio, subscribe to WealthSpark Daily for more simple investing content.